Well, good morning, everyone. Welcome to our 2023 nonprofit conference. Sorry to break up all the great chatter. We'll give you some of that time back a little later. My name is Wayne Pinnell. I'm the managing partner for Haskell & White, and it's my privilege to welcome you here this morning on behalf of our partners and other speakers. We have a pretty packed agenda for you to cover a number of things. Hopefully, it is less technical and more entertaining, but you'll have to be the judge of that when we're done. A couple things before we get into the agenda items from a housekeeping standpoint. Once you've enjoyed the food and all the beverages, if you find a need to use the restroom, it's out the hall, down the left, down the other corner. Right? Parking, you should have dropped your parking ticket off in a little glass on the back table. If you haven't done that, maybe do that when you make that restroom run. They're going to go stamp all those at the end and give them back to you on your way out. If you do need CE credit, we are offering that. We do have signed certificates for everybody. So if you need CE or you just want a souvenir, we have those out at the back table as you leave as well. Okay, so we're going to get into the program now. We do encourage questions along the way. Joyce is our esteemed timekeeper up front here. So if she starts waving wildly at me, it means we're out of time and I will talk even faster. All right. So we're going to get going now. So first thing, to the commercial, for those of you that are less familiar with us and you received an invitation to join us today. First off, I do have to welcome also all those folks out on Zoom. So you can't see this, but this conference is actually a lot larger than you see in the room here today. So it's not a record for us, but we are calling this our first post-pandemic record. So we'll do that. All right. So yeah, thank you. So it is good to have so many people back in a room and be able to get a great breakfast out there, which I'm looking forward to. I chose to eat after I speak. So Haskell & White, we're a middle market focused firm. We serve clients in the for-profit arena, of course. Today is all about you, the nonprofit sector. We have a great reputation around town for serving nonprofits. We've got a great morale boosters inside. We got people to think we're a really great place to work. We've won some surveys in that regard. We do practice at a level that we believe is technical competencies on par with the larger firms in the country, around the world, but we do it with a much friendlier face and style, more akin to a small firm, but I gotta say, much more technical than a small firm. So not to get to that three bears thing, but we're kind of the ones that are just right in the middle, all right? We do serve our nonprofit community through doing audits, single audits, if you have to have those, the 990s, et cetera. And we do, as a rule, serve on a lot of boards ourselves. We have 20 boards that we are volunteering for in some way, shape, or form throughout the tenure of the partners and managers predominantly. And we also have a very good quality record as we get inspected by the PCAOB for our public company work. And we have AICPA peer reviews for the work that we do for you all. So a bunch of talking heads that'll be up here today. We've got several of our partners and a couple of guest speakers. Rick, who leads our audit practice, Diane, an audit partner, Paul and David, both audit principals. David Buchanan is online with us today. So when we get to his portion, he'll be remoting in. He is our virtual CISO. So he takes care of our information security. And then we have our guest speaker, Brandon Murray, joining us today too, which I know some of you know, because I think he might be managing your money or something. So, all right, so let's get into the topics here. So the first one, I'm going to present this to you as both an auditor and a board member. And what we've seen over times going through this process is there's oftentimes confusion, you might imagine, between fundraising programs and the finance people. Okay, so the first thing we want to do today is check who's in the room. Okay, so on Zoom, they're answering this with a polling question. You're not doing that here. On Zoom, I see answers here. I'll give you what those are in a second on Zoom. But for purposes of the room here, how many of you are in programs? All right, just 2 people for programs. All right. Finance. Okay, a lot of finance, fundraising. All right. Well, not that we're not going to do this by sheer weight of votes, but fundraising, you got to carry the day because I'm talking about those finance people. How about CEOs or executive directors? Okay, and then any other that you didn't. Okay, we have one other. What is? Well, Haskell & White people, we know who you are. What is the other? Nonprofit consultants. Okay. All right. So all of the above. All right. So online, I just lost the poll, but the largest group that was represented online was Finance, okay, finance professionals. All right. So you have to take that off of there. All right, there we go. So the goal today in this section is to talk about how program people need to work with finance people who need to work with fundraising people, right? All part of the same organization, hopefully all have the same goal, but oftentimes there's things that get in the way, which lead to misalignment. Right? And misalignment happens in various forms. One is there's just a lack of collaboration, bunch of silos. Programs over here, finances back in the back corner with the green eye shades on to handling the money. And then the fundraising people out there telling stories in the community trying to get the money, right? Not necessarily all talking the same language to each other, right? Which becomes a possible trust issue between departments because one's off doing something else versus another. We've got communication breakdowns when that all happens. Inconsistent terminology. We're going to cover a couple of those things later on because fundraisers sometimes have terminology they like to use. And on the accounting side, we have terminology that doesn't match, and that can cause some very frustrating times at times when people are trying to record revenue or hit a goal, okay? And then there's a lack of clarity on how programs are funded. And some people do make donations specifically to a program. Others make donations generally, but those have to be accounted for and tracked. Okay? And of course, we know there's constant changes in reporting and regulations. So those keep changing the language we might use. We've had some significant accounting changes in the past few years that people are adopting new ways to think about revenue recognition for one, change some of those words around. And then policies and procedures sometimes are just undocumented, which no surprise, we see this in all sorts of organizations. They do things because that's the way they did them yesterday. And when somebody leaves, there's a new person trying to do it tomorrow who doesn't know how it was done yesterday. So documentation can be very important. And then finance, often we're just seen, I'll say we're seen as overhead. Okay, so finance is not overhead. I will make that bold statement. Finance is not overhead. It is a very critical part to the organization to make sure that things are being reported correctly, not only through your financial statements and your 990s, but out to your boards and the community. And cash, of course, is always king, but we need to make sure it shows up in the right places because there is sometimes a fight for what's restricted and unrestricted in terms of where the money's going. Okay? So setting that stage, why do you want to have synergy then, which is the flip side? If we have all this misalignment, what can we do to bring folks back together? And this is weird. So I have distance glasses. That's not far enough away, but I don't want to lead in here. And I don't want to keep turning around. All right, so we want to have people aligned so the decision makers all hear the same message, right? The constituency all hear you have one goal in mind or your one mission in mind, even though you have these other moving parts. So that's the commitment to the mission first. If we start at the top, even though there's separate functions, okay? And we want to make sure that there's a focus on maximizing every dollar you get toward the mission, okay? Enter that problem about finance being cost. There's sometimes a misalignment in how operations work inside a nonprofit because dollars need to go to programs, but that doesn't mean you should spend necessary money on back office structure. Okay, so there's a balance. And then this last one here, programs are what gets funded first, of course. Just to hit that from a different angle, we don't want to be saying fund the programs, but not the other stuff. Okay? All right, so if we have synergy, it also improves the donor experience. Donors feel like they know what you're doing with their money. It's got a consistent message back to them anytime you ask for the next dollar. They know where it's going. They feel like they've made a difference with you and your organization. You're able to share common data and challenges. I've been on the board for some nonprofits where we actually have, in some people's view, a lot of money. But we still need to be able to go out and raise money. So the messaging becomes very important. How do you share that information and data so that you keep funding a necessary program? Efficiency gets improved. Okay, we see that just as auditors, right? If we're all talking the same language and working with the same documents, we can be so much more efficient. You as program, finance, and executives, fundraisers, if you're all sharing and working off the same database, it can be very important. I've had clients where we have seen records of revenues, and then we see the donor database. Do you think they match? They should. Yours do? Good, okay. They don't always, okay? So we want to make sure we're working off the same data, okay? And then your information will improve watchdog organization. This is hard with this last one. Okay. So it will improve the watchdog organizations, like the folks that are out there giving you, 3, 4, 5-star ratings, okay? So I'm just going to cheat and move this here so I can see just a little bit better, okay? So we want to be aware of the disconnects, okay? Fundraisers sometimes count versus finance that does accounting. We'll come back to some examples on that. There's challenges sometimes when you're trying to meet a fundraising or a campaign goal. And I don't want to say fundraising can be like sales, but I will, because then at some point sales become like salesmen or saleswomen. And the worst example we can all think of is the used car salesman, right? We don't want to be used car salespeople out there trying to raise money. And then there's a question about special events. I'll give you some examples. We're used to having special events, but do we have to have special events? Let that question linger for a second. And then we've got things with grants and other ways of getting money. Right? So when we look through these other areas that can affect procurement, leases, and other commitments that the organization is making, even if they're being things provided to the organization, perhaps free of charge. Communications, again, get all wrapped up in what you tell the story is internal, external, your board, other constituents, and then really figuring out how you define best what those goals are and when you're meeting them, because there is counting towards a goal and there's accounting for a goal. Could be possibly different information. All right, so let's look at a couple development and accounting differences. Okay. So first off, contributions receivable. Big question here. You record a receivable when? You don't have to answer it. I'll give you the answer. Okay? You record a receivable because somebody has made a donation, or I will use this word, promise to donate. Okay? We're going to look at some technical language to play around with that in particular, but we've got to deal with whether there was a promise to donate or simply an intention to donate. Okay? And whether it's unconditional promise or it's an intention, if the sun comes up on March 23rd, 2027, I will donate the money. Okay? We don't know where that is yet. And then the big question about whether things are done for budgeting or planning, or they're really becoming donations, and whether or not it's verbal, and I don't like that word verbal because it could mean written, but oral or written agreements. Okay? Writing always overrules oral. So, if you are into the accounting standards codification, pull up this little section on defining what contributions are. There's some key words in here. In paragraph 25-8, contributions receivable, what you record, are supposed to be evidenced in a sufficient manner with a form of verifiable documentation. Is that oral? It's kind of hard to say oral is documentation. Okay, there's ways to work around oral. If somebody says something, you feed it back through an email channel, but we need to have documentation, which is something in writing. 25.9 is a communication that does not indicate clearly whether it is a promise is considered an unconditional promise to give if it indicates an unconditional intention to give that is legally enforceable. So if it's an unconditional promise to give legally enforceable, important to understand that doesn't mean you are actually going to enforce it legally, but if it's like a contract. You should be able to take it to a court and say, you promised to give me $100,000, I'm here to collect the $100,000. Okay? And the third part on here is solicitations for donations that clearly include wording such as information to be used for budget purposes only, or clearly explicitly allow resource providers to rescind their indication. You get the point. Soften it, and no longer do you have something that is sufficient to provide an unconditional promise and book that revenue and receivable. Now, a couple quick examples. I know fundraisers, I've had this conversation with those that work for boards, I've had those with conversations with clients. Somebody gives you an unconditional promise to give $100,000 a year for 3 years. I know fundraising professionals hate to have to record $300,000 in that year because they want $100,000 to go toward their budget or their goal for each of the next 3 years. But if there's an unconditional promise to give you $300,000, you book it now. Finance likes to book it because the financial statements look good, right? So we've got to talk the same language. Here is, and I'll give you another kind of a strange example. I was on a board there. We had a promise to give that was oral to fund a capital campaign project item in its entirety. It's in the board's minutes because the member that made that contribution is a board member. Board member passed away. We don't think his widow knows he made the promise. So guess what? We're not going to go ask her. Kind of sad, but we've got to find other sources. Huh? But here's some things that cause confusion, because this is an example out of some actual donor-type letters that people have sent out. And hopefully you see some things that are really bad with this to try to achieve an accounting goal. Anybody got one? You see something right now? Okay, right in the middle of the page, this letter of intent is not a legal obligation. Okay, we throw that one right out, right? You blew it. First thing, the title was letter of intent. It's not a promise, it's an intention. Huh? So you got to be careful with the language. I've seen things come out for budgeting purposes only, and I know some boards that I'm on, we send around annual board goal forms that say, what do you intend to sponsor over the course of the year? You know, this outing, this event, this program. You fill in a bunch of numbers, and then this one particular board, we get a report about 9 months in, which I just got, and it says how close you are to the goal you set out. But we don't record any of that until it happens, right? Because at the beginning of the year, when I make that budget, I may not actually do it for that particular event. Huh? So I think there is a polling question. And online, you can answer that question. And then here in the room, how many, well, I'll give you a second to read it. But we can take a poll here and see how many people think they have the right answer. So how many vote for number 1, a letter of intent is received? We can book revenue. Okay, so far so good. Either you're paying attention or you knew the answer. That's good. All right. Number 2, fulfillment of a request for information for budgeting purposes only. All right, we're still doing. How about number 4? Whenever deemed necessary to meet budgeted goals by year end. Yeah, okay. Yeah. I know some people like that. So obviously number 3 is the right answer, right? Legally enforceable, unconditional promise to give is received, and we can book the revenue. All right. So we look at some other challenges that are out there. And just so the next speakers know, you have to clear your polling question before you can go on. All right? So some other examples. Sometimes people say, oh, that organization is in my will. Okay. Well, there's a couple problems with it just being in the will when you record it, because first off, it's somewhat conditional. You get the point, right? Somewhat conditional. There's got to be a terminal point of that arrangement, all right? But wills can be changed. If they're not set up in irrevocable type arrangements, they can be revoked. So there are organizations that have what they might call a legacy society or some type of thing where they have cultivated donors to say they are putting the organization in their will, and they'll use that for marketing materials and that type of thing. And it's nice to be able to build up that relationship base with those donors that have been so good to the organization, but obviously we can't count the revenue until the terminal event occurs. Okay? And then charitable remainder trusts have some other issues with them, and I'm not an expert in this area, so I'm just going to let you know that it's out there. If you have charitable remainder trusts that are signing you up as potential beneficiaries, you do need to check maybe with some counsel and understand who's actually determined the rate of funding, how old the person is that's making that arrangement. Maybe they're a little bit on the young side to be making that decision right now, and again, maybe that could change over time. And whether or not your accounting folks are actually involved in the whole arrangement in the first place to understand it. Oh, a question from Zoom. Yes, I can't hear you.
Even if you have an unconditional promise to pay unless backstopped in a will, then will the executor enforce?
So I'll try to repeat that and see if I got it right. So even if there's an unconditional promise to pay built in a will there be a legal obligation? Will the executor enforce that? So The technical answer should be yes, because the executor, by definition in a will, is supposed to carry out the wishes of the donor, and they are taking on a legal obligation to do that. I would say the downside of this, though, is if the organization knows the person has put them in their will and doesn't necessarily get a copy of the will, which may not be a normal everyday occurrence, they might have to actually go get a copy of the will to see what that obligation was. So it can become a little bit more hairy, but I would hope that an executor in good faith would make good on that promise, because it should be enforceable. That's why we have probate courts, for one thing. Okay? So on the polling question, just credit to Zoomland, 88% got it right. So, all right. So then we have other things that can cause confusion, cause frustration between departments, cause outward communication gaps to the community. Development folks, in the interest to raise money, may start, I'll use the term the auditor's room like, they might start throwing sweeteners on the deal. Well, if you donate this, we can do that. You know, you start putting these ifs and ands and buts on these things. You start creating restrictions, which can then water down whether or not that contribution can be done right now. So it's great fundraising efforts to get somebody who's willing to do a match campaign. You know, if people put in 50 grand, I'll match it. First word was if, right? So you can't book the 50 grand until the other 50 grand are in there, okay? In kind, okay? A lot of things you got to figure out what the value is. It can be a challenge for any organization to come up with values, and I'll come back to that in just a couple seconds. I went too fast. Okay, this one. So special events. I mentioned this before. Everybody's had organizations that have had special events, and every year we have to do that event. Have to. I was on a board, we did a golf outing for 26 years. Year 27, we said, nah, no more. Because after spending countless hours getting volunteers to man every hole, seeking donations, paying for the country club, we netted 80 grand in the 26th year. It didn't make any sense. We did a one-night exclusive dinner, 10 tables, we raised $150,000. We didn't have the slew of volunteers and all that time put into it. So there are other ways. So finance, CEOs, program folks, think about it. It doesn't have to be the same event every year. And what's often missed, maybe from finance, maybe from people who put the program on, what were all those other allocatable costs or intangible hours that were spent to put on this event to make $80,000? Right? We often forget about those. So whether it's a golf outing, the gala, the casino night, really take a hard look at those. And we've got some other weird things out there that people do. Some people like to pledge their PTO back to the organization. Employees of the organization want to give their PTO back. They can't really give their PTO back. That's not a contribution. They can cash out their PTO and donate the money back. But in order to donate actual PTO time, it causes a bunch of payroll tax issues. If you get some of the private company or other non-cash items, things to think about here. Do you have a donation policy? What things are you willing to take? Do you want to take public company stock? Do you want to deal with private company stock? Are you open to real estate, crypto assets, art, etc.? Be prepared to say no, but we'd love to have your cash, right? Because some of these things are too hard for the organization to take on, figure out fair values, manage the asset while they hold it, manage the effects of selling it, and sometimes the selling costs could negate the benefit you had in the first place. All right, so closing up this last slide, and Joyce is like, God, she's got me right on time. All right. So when we're managing or meeting fundraising campaigns or goals, again, very important that communication is between finance and fundraising first and foremost. Let's not just count the number of people that come to the event. Let's think about what the accounting for the dollars raised is. Let's think about what the cost of the dollars raised is and be able to communicate that back out to those that attended. They like to know that they made a difference. You put the article in the newspaper, so-and-so had a gala last weekend, they raised X dollars. I always wonder when I read those, is that net? Is that before expenses? And then the boards, of course, always want to know what they're doing. So hopefully that's enough to get you started. If you've had misalignment in your organization, you can get some of your folks dealing with some of the issues. Certainly, if we happen to be your auditors, we can help you work out the language you're using. If we're not yet your auditors, we're happy to talk to you about it anyway to help you get aligned. So with that, I'm going to bring up Rick, who is going to get into the next topic on endowments, and I will hand over the magic clicker.
So thank you, Wayne. You always manage to put the fun, F-U-N, in fundraising, so well done. So the next topic we're going to address this morning is investments. And it fits in a lot of ways. One is because Wayne was just talking about receivables, so when we convert the receivables into cash, we have an opportunity to invest. Also, we're coming off a pretty wild 2022 year in terms of what the investment markets presented everybody. And then if you were fortunate enough and you received some PPP funds in the last couple years, maybe you received some ERC. I know there's some folks in the room that received SBOG funds during the year. You might find that your balance sheet is flush with cash and you have some investment that you can make. So I think this topic is super timely for everybody. So we're going to start off with the polling question. And the reason we do the polling questions is so that the folks that are attending on Zoom land, they can receive CE or CPE credits. So we do these polling questions, and maybe here again, you can just think of the answers to yourself. But the first polling question we have this morning for investments is the 2005 California Nonprofit Integrity Act, and hopefully we've all heard of that, requires nonprofits with more than $2 million of investments to have a separate investment committee to oversee the investment performance. So is that true or false? It's a little bit of a trick question. It's actually false. It's actually false. What the Nonprofit Integrity Act does, actually we got to clear this, I think, Wayne said. Do we have to answer this, I think?
You don't have to answer it.
Okay, just close it out. Okay. What the California Nonprofit Integrity Act does say that if you have $2 million of gross receipts, you're required to have an independent audit done every year. And it says you're required to have an audit committee to oversee the audit. And it gives you some rules about the composition of the audit committee and who can serve and who can't. But there is no such requirement for an investment committee, at least not at this point. So a little bit of a trick question. Okay. Doesn't want to move. Okay. So this morning, first thing we'd like to do is talk a little bit about the U.S. GAAP reporting for investments and how we present investments in our statement of financial position and the statement of activities. We're also going to invite Brandon up to speak a little bit about the current investment environment and the importance of good asset allocation, especially as we go through turbulent times. And then the last thing we want to discuss this morning is a little bit about endowments and how an organization manages its endowments. What is a board member's, what is a management's fiduciary obligation to oversee the investment portfolio? And we're going to talk about a law called UPMIFA. So hopefully folks have heard of UPMIFA before. And if not, we'll introduce that topic to you this morning. So let's do a little bit of a GAAP overview of what the statement of financial position might look like for investments. So on the board here, you see some common investments that we'll see on the statement of financial position. Equity securities, debt securities. GAAP is fairly simple in this regard. You record the asset at purchase cost, and then we do mark to market, so we adjust it to fair market value. And all that seems pretty straightforward, right? But remember, maybe back to your accounting or your auditing class, what happens if you have a position in a security and you have what's called significant influence over that entity because of the amount of shares that you own? So let's say you own maybe 20% of a company. And in the accounting world, if you remember the term significant influence, if you have significant influence over a business, then you can't use fair value accounting. You have to use what's called equity method accounting. And so now we're recording things at cost and we're picking up our pro rata share of income or loss. So again, depending on the percentage of the business you own, you might not be able to account at fair value. So just be aware of that. What happens if maybe, Wayne was talking about board members making donations. What if a board member works for a private company, maybe he's an owner, maybe they donate some shares in a private company to you. And you say, okay, fair value accounting, well, what's the fair value of the shares of the private company? They're not traded on any exchange. We don't really know what the fair market value is, so what do? So in that case, we have a solution in GAAP that says in those cases where you don't have a ready market value, let's account for it at cost, and then let's just monitor for impairment. So maybe we have evidence of a struggling business. Maybe we can read a release in Google, we can do an internet search, we can talk to the board member. But if we have evidence that they're struggling company, we have to record an impairment. And then the other obligation we have is to watch that company, and if it's raising money and it's selling securities like we own, there might be evidence that there's a different fair market value that we can use. But private companies, we do have to pay a little bit more attention to. Debt securities, very simple. We record those at fair value. This is one of the few places where GAAP for nonprofits and GAAP for for-profit companies actually diverge a little bit. Andy and I were talking this morning about Silicon Valley Bank. And again, very complicated story about what happened to Silicon Valley Bank, but one of the things that's well documented is their accounting for some of their debt securities were at cost, not fair value. And so for-profit companies do have an option to account for it at cost if you call them held to maturity securities, which is what Silicon Valley Bank did. Their intent was to hold these treasury securities till maturity, so they got to account for it at amortized cost. Well, that was all great back in 2019 and 2020, but when interest rates started going up, what happened to the value of those treasury securities? They went straight down. But was that reflected in their financials? No, because they were recording it at cost. So they had these hidden losses on their balance sheet. And then when the redemptions came in from the depositors, they had to liquidate those securities. They realized the losses and they didn't have enough money to give out to everybody. So again, a little divergence between for-profit and nonprofit here. Other investments, some folks might have heard the term alternative investments. Those could be private equity funds. Those could be venture capital funds. Those could be funds of funds. So what do we do with those? Those aren't usually traded on an exchange. So what's the fair value? Well, again, we have another GAAP practical expedient that we can use and say, if we don't really know the trade, there's no readily available trading value, we can use the values that the fund manager provides to us. Those are typically called net asset value, NAVs, right? So the funds report to their investors. They say, this is what your unit is worth, or this is what your share is worth, and we're allowed to use that as a practical expedient for fair value. How about investment pools? Maybe some of you have money invested at maybe the Orange County Community Foundation, maybe the San Diego Community Foundation in an investment pool. So how do we report those? Again, no trading value on those. We're just part of a big investment pool. They're aggregating other nonprofits and they're making some investments and getting the economies of scale. Similar concept, we can use net asset value. So again, they would provide to you what your share of the pool is, and we can use, a net asset value as a practical expedient. I don't want to go into real estate investments. The only thing I want to say about real estate investments is if you are investing in real estate entities, so maybe it's a general partnership, maybe it's a limited partnership, maybe it's an LLC, depending on how much of those entities you own or have an interest in, depending on if you're a limited partner, general partner, member, managing member, the accounting can be very different and very complicated. So just know that, beware of the real estate entities. So let's turn the page in our financial statement and flip over to the statement of activities, okay, or our income statement, if you will. So gains and losses, as we know, run through the statement of activities. That could be interest, that could be dividends. We could have realized gains and losses, but we also have unrealized gains and losses that are running through our statement of activities. Doesn't run through the 990. Remember, that's the one place where the 990 differs from your GAAP financials, is on that unrealized gains or losses. We don't put that in the 990, just the realized stuff. But for GAAP financial statements, we do use the unrealized gains and losses. One thing that's a little bit tricky would be as if you had unrestricted funds and they were invested and you earn some interest, you earn some dividends, maybe you earn some unrealized or realized gains. But until they're appropriated for expenditure by your board, they're still categorized as with restrictions because they have not been appropriated for expenditure yet. Okay, so you say, okay, I have unrestricted investment funds, but the income that's coming off of it, I have to report as restricted because they have not been appropriated for expenditure. Once your board approves it, appropriates it for expenditure, it becomes unrestricted. But there's that time restriction there we have to pay attention to. Investment costs. So unfortunately, firms like Brandon, you pay an investment management fee, right? Pay for the expertise to manage a portfolio. Maybe you have an internal person. Maybe your organization is large enough and you have an internal person that's doing some portfolio management. What do you do with those costs? Well, GAAP used to be a little bit diverse. Some companies recorded that as net of the investment income and investment returns. Some companies reported those as just expenses. If you had a $5 million investment portfolio and you paid 100 basis points, that's $50,000. What if an organization was recording that as a G&A cost and another one was recording that net against the investment returns? Could throw off some of your ratios, right? How much of your expenses are going to programs, how much of your expenses are going to G&A, could throw off some ratios. So a couple years ago, GAAP fixed this and they made it mandatory. Everybody has to report it net of your investment returns. So all your investment expenses go net against your investment returns. They do not get reported gross as expenses. This slide is lovingly called the most important footnote. This was a new footnote requirement back with some of the accounting changes we had after 2018. And this is really meant to emphasize liquidity in a financial statement. The nice thing about this footnote disclosure is all nonprofits will have it. You can, whether it's Bill and Melinda Gates Foundation or the smallest charity that you can imagine, this is a GAAP requirement to disclose this. And what's really great about it is it really, again, highlights liquidity. And this was a response to the last financial crisis we had where a lot of folks discovered nonprofits were not as liquid as they thought. And then this requirement was born. So what we're required to do with the numbers is disclose the financial assets that you have that are available for general expenditure, and that's what you have at the top of this chart. And it's accompanied by a really nice qualitative narrative about how the organization manages its liquidity. This example here is right out of the accounting standard, so if you haven't seen this before or if you want to compare what you're disclosing now, this is right out of the standard. So this might be a good item to benchmark against. But just wanted to highlight because, again, that's a really important disclosure in financial statements today. So before we introduce Brandon to give some thoughts on the current market environment, again, check in on the pulse here, everybody, and you can just kind of think through your own answer here. But when we think about 2023, what are we expecting in terms of market returns? So let's pick the S&P 500 index. What are we thinking we're going to end the year? So this is where you get to take out your crystal ball and do some predictions. So we're going to be a 15% loss. We're going to be around 10% loss. We're going to be break even or maybe plus 10 or maybe even greater than 15% returns. Extra bonus question today is anyone want to guess where we're at as we sit here this morning in terms of the S&P 500 so far as we're, 3.5 months into the year? If you said about 8.5%, you get the prize. We're up about 8.5% already on the S&P 500 this year. So good performance. So think about your answer there, and then I will invite Brandon up, and Brandon will share some thoughts on the current market environment.
Thank you, Rick, and thank you everyone for having me here today. I love this question about where markets are going to go. I'm sure that's what everyone expects I'm going to tell them today. But unfortunately, I'm not going to be able to tell you where markets are going to be at December 31, 2023. I think a more appropriate question that kind of dovetails perfectly into my conversation today will be about where markets will be 10 years from now. We're talking about long-term allocation of assets. That's an easier question to answer. Still not perfectly, you still can't answer it perfectly, but much easier than where's the short term. So we want to shift our focus to the short term. So before I get into that, let me introduce myself. My name is Brandon Murray. Some of you might know me, but for those of you who don't, a little bit about myself and my company. I work at Canterbury Consulting. We're a registered investment advisor based just down the highway in Fashion Island. And we work on family offices as well as nonprofits, so foundations and endowments in areas of arts and culture, community foundations, healthcare, higher education, and religious organizations as well, just to name a few. So today, as I was mentioning, the conversation I'd like to have is about asset allocation, generally, and in the lens of the recent market experience that we've just had. Asset allocation is a very hot topic. When you're meeting with your investment advisor on a quarterly basis, you're seeing that allocation every day. You're questioning it every time. You're bringing in short-term perspectives to a long-term objective, and it's tough to do that when you have headlines that are coming in hot off the press every morning about what's going on in the markets. It makes you question that allocation. But to understand where we're going, where we are now, where we want to be, we want to look at what just happened. So just to highlight a little bit of what's happened over the last 3 years, plenty of challenges for portfolios, and namely in the last 18 months, to say, certainly to say the least. But even when things were going quote unquote well, in response to the pandemic, equities were doing very well. 2020 and 2021, there were challenges for organizations because the outlook going forward was bleak, or relatively speaking. So looking back at the response to the pandemic, certainly plenty of money printing happened with the Federal Reserve. There was a large response to make sure that the economy was still going to move. And we started getting language from the Fed saying that any inflation that we might see won't be persistent, it'll be transitory. That was the buzzword. And the entire market believed that. So there was no pricing in of what happens if inflation isn't transitory. And that's what we saw with the effects of 2022. The inflation got caught off guard the Fed got caught off guard as well with inflation, and had to react in quite a dramatic fashion. And that meant having to cut their asset purchases completely to zero, as well as increase interest rates at a clip that we hadn't seen before. So in the course of the 12 months of 2022, we saw interest rates go from effectively zero, up to 4.5%, seven different rate hikes. That interest rate hike is fully to blame for the turmoil that we saw through 2022. It was responsible for the repricing of equities that we saw, quite a dismal bear market that we saw, and as cash flows for these equity stocks had to be repriced with a new discount rate. So that's not something that's unheard of or uncommon. Equity market volatility. We all come to expect that. If you're an investor for any amount of time, that during the course of a business cycle, there's going to be some corrections, there's going to be some bear markets in your equity portfolio. We've seen those double-digit losses before. What was truly unprecedented and appalling was the return that we saw out of the bond portfolio. So we have a diversified portfolio, we'll call it 60-40. It wasn't quite 60-40 for many portfolios by the time we got to the pandemic. And we'll touch on that in just a second. But those bonds, so we're talking treasuries, we're talking mortgage-backed securities, they took quite a drastic hit with that spike in rates from fed by the inflation, and to the tune of down double digits, and the worst return for bonds for a 12-month period that we've seen on record. That is not something that you want to see in a diversified portfolio, to have equity-like returns coming out of a capital-preserving asset class. So there was really no place to hide for investments. You had your equities that were doing their thing, and then you had your bonds that were being repriced. So certainly challenging, and we all lived through it. But I think that's the important thing to take away from this. We lived through it. It's priced in. The cookies are baked, they like to say. Now is not the time necessarily to all of a sudden say, oh, we should have gotten out of bonds then, so we should get out of bonds now. Oh, we should have got out of equities then, we should get out of equities now. we want to make sure that we're keeping our focus on moving forward. With that repricing in both equity markets and in the bond markets, there's a complete shift now as to what the outlook will be going forward for the next 10 years. With rates as low as they were, looking back over the last 10 to 15 years, multiples for equities had ballooned up to levels that were unsustainable. And it was proven in 2022, unsustainable, they needed to be repriced. With that repricing, they are now brought back down to a level that's relatively more in line with long-term averages. That gives it a little bit more room to run going forward. Likewise with bonds, with the rise in interest rates and the inverse relationship with bonds, their rates were going up, their prices going down. We have those prices have gone down, but yields now baked into those bond portfolios are much higher than they've been in recent memory. So if I can take a step back and touch on where we had portfolios at in 2020 and 2021, interest rates in a bond portfolio, yields were expected to be 1%, maybe 2%. That's not a good starting place when you have an organization that's trying to meet a 5% spend rate and needs to grow the assets to hit that 5%, and then inflation, and maybe a performance buffer on top of that. So it became very challenging to talk about asset allocation. We had to really look at the portfolios, and really the only answer, if nothing else is going to change in terms of your organization, there's not going to be an increase in donations, there's not going to be an increase in revenue, then that generation is going to have to come out of the portfolio. So naturally what you have to do is push up the risk spectrum. So we saw portfolios go from 60-40 down to 80-20. 60% stocks, 40% bonds, down up to 80% stocks, 20% bonds. So, and that's just in order to get the return coming in to the portfolio. And then not only that, not only just the risk going into equities, but even within that 20% for bond portfolios, we saw some more risk taking as well. There was some credit risk that was reached for, and then also illiquidity, which was common for the equity segment of the portfolio. There was some illiquidity being taken in bond markets as well. So private credit, if you might have heard of private debt, in that 20%. So we started to see bond portfolios having a little bit more correlation to equity, the equity side as well. So what does that mean? Where does that put us at today? So with this repricing, as I mentioned, yields are much higher now than they have been in recent memory. That means that the bond portfolio can produce some returns. We can expect it to produce some returns over the long term without having to reach for as much credit risk or maybe even some illiquidity. You don't need to reach as much for that. It might not mean that we go back to a 60-40, but certainly we can keep the bonds acting more like bonds. We can have more treasury exposure. I think the 10-year now is at 3.6, 3.5%, somewhere around there. And your cash finally is making quite a bit. It's about 5% now. So if you have some short-term cash needs, you can have that working as well. So there's just more opportunities. There's more productivity coming out of all segments of your portfolio. So when we talk about asset allocation, I think the main takeaway that I want to have from here is that asset allocation is supposed to be a long-term conversation. The asset allocation that you study, that you do with your investment advisor, takes into account, there's a lot of calculus on the back end that tries to factor in all the risks that go into being exposed to these markets. And it's supposed to educate what the expectation is going to be over the next 10 years. So when you get a number that's kicked back from you, two numbers, you get your expected return and your standard deviation from that asset allocation study, that is supposed to be what your experience should be if you make no changes at all. You want to keep it that way, and the returns will generate. That asset allocation will be responsible for 90% of your returns. The other 10% might be tied to some market timing that's nearly impossible to do. So when you're having these conversations with your advisor, it's important to remember that yes, we are having headlines that are coming through all the time. It seems like every single time there's a headline, there's something that says unprecedented, and this is going to change everything forever. But remember that in that standard deviation, which is your expected range of returns, it's factored in there over the course of 10 years, and that's why that question was so good. We are 8% up right now in the S&P 500, but we don't know what's going to happen tomorrow. We don't know what's going to change in the landscape of equities. That could flip around really quickly, or it could ramp up. We don't know. It's very common to get questions about what the Fed's going to do next. It's very common to get questions about what to expect from certain sectors, and so on and so forth. But the broad asset allocation, understanding what equities will do over a 10-year period, understanding what bonds will do over a 10-year period, that'll be where you should live. So that long-term allocation for the portfolio, that your mindset should match that as well. So when we're bringing in portfolios to review, remember that certainly this last quarter, this last year that we had was crazy to say the least. But we want to look at the next 10 years. We want to look at the last 10 years, how did they do? What was our expectation for that, and how did it perform? So I hope I didn't give too much industry jargon there, but I appreciate everyone having me here to speak a little bit. If there aren't any other questions, I think I'll pass it back on to Rick. No questions? Okay. Thank you.
Well done, thank you. Yeah, Brandon, such a great friend of the firm, and Canterbury's such an asset for Southern California. So Brandon, thank you for all the work you do. Thank you to Canterbury for partnering and helping the nonprofit sector like you guys do. So we're going to finish our session here on investments with some endowment talk. And there's a couple of key phrases that I want to make sure that we all understand when we talk about endowments, because sometimes the language can get confusing. And whether you're talking to an investment advisor, whether you're talking to an auditor, whether you're talking to a board member or donor, some of these definitions can get commingled. And so I want to just make sure we emphasize a couple of these. One is, when we're talking about endowments, sometimes the attorneys in the rooms might think about gifting instruments and monies that you can't use today. The auditors are probably thinking endowment, well, that must mean it's permanently restricted. The donor's saying, well, I gave some corpus that's permanently restricted, but I want you to be able to spend the income in current periods. So there's a little bit of confusion there. So when we say endowments, a general way to speak about endowments is they're really all the funds that an organization has that can generate income so it can pursue the mission. Sometimes we have donor-restricted endowments, and again, that's when the donor has restricted the funds to be used in a certain way or to be held in perpetuity. So maybe we use that donor-restricted funds to specify those funds from something like, you might have heard the word quasi-endowment. Quasi means almost, but not exactly. Okay, so that doesn't, almost not exactly endowment doesn't sound great. But a quasi-endowment, that would be something where maybe your board designates. So maybe you have some surplus funds, the board wants to set aside some funds. Those are not restricted by the donor. They're not legally restricted. They're just designated by the board. So in a financial statement, we don't present those as with restrictions, because only the donors can restrict a gift for GAAP purposes. Underwater endowments, that might be a term that we hear a little bit more frequently given the events of 2022. Underwater endowment means a gift was made and subsequently the market value has taken that gift below the original dollar amount. So if Pat Ross gave $100 and then that $100 got invested, by the end of 2022 it might only be worth $75. So that would be called an underwater endowment. And then again, an investment policy, spending policies, those are fundamental documents that any organization should have if you have some investments. I want to introduce the term MIFA to you, if you haven't heard of it before. It stands for the Uniform Prudent Management of Institutional Funds Act. I know that's a mouthful, but essentially what this does, it's a uniform law that informs management and informs a board about your fiduciary obligations to oversee investment funds. So believe it or not, you do have a fiduciary obligation, and there is a uniform law that gives you guidance in terms of how you should perform those functions. In California, we adopted UP-MIFA in 2009. There was two big changes when we made that switch from UMIFA to UP-MIFA. UP-MIFA put the word prudent into the act. Under UMIFA, we couldn't spend on an underwater endowment. So under the old law, if, again, Pat Ross's $100 turned into $75, the organization couldn't spend, which could be very frustrating, right? You say, well, we have these $75 here, but we can't spend it because it's beneath the corpus amount, the original dollar value that the donor gave. The other thing UP-MIFA did over UMIFA was it let us consider unrealized gains, and we can actually spend unrealized gains. Under UMIFA, we couldn't, because the unrealized gain was really viewed as more like the corpus. You could spend interest, you could spend dividends, but that unrealized gain, if you had bought some securities, you couldn't consider that for expenditure. And so that led a lot of nonprofits to shy away from growth investing and stock investing and weigh their portfolios more heavily in bonds that yielded some interest. So under UP-MIFA, there's really two main principles to focus on. One is how you invest those funds. What are the standards that you're held to in terms of your investment decisions? But then also how you spend those funds. And each one, they make it easy to remember. Each one has 7 really characteristics underneath them that a board and a management team should consider. And I'm not going to go through all those now, just to keep things a little bit brief here today. But just know you've got the slide deck in front of you. Please look at these 7 conditions here. The other 7 here for spending are also here. I want to highlight. Make sure you take a look at those. The last couple bullet points here, in California, and so UP-MIFA is really the law in the United States. For some reason, every state except Pennsylvania. Pennsylvania has not adopted this, so if you're a charity in Pennsylvania, this won't apply to you for whatever reason. But the one thing that California has adopted, not all the states have adopted, is the third bullet point from the bottom. And it's this idea about, is there a safe amount I can have in my spending policy? And what California has adopted is it says that if you use a 7% spend rate, and again, that's calculated over a 3-year period, but if you're spending 7% of your endowment funds, that's a rebuttable presumption that it's not prudent. It's too much. And I think the thought behind that is, do you really think that you can generate portfolio returns in excess of 7%? Because if you're spending 7% every year, can you really generate 7% every year? But by the same token, the law says that if you spend less than 7%, that doesn't mean that it's automatically prudent. And a good example of that might be, what if you have a super conservative investment committee? And just to use an extreme example, let's say that you just invest everything in cash, and you don't want to take any bond risk or any stock risk. Everything's invested in cash, and over the last couple of years, you got 1 or 2%. What if you're spending 5% every year out of your endowment? What's eventually going to happen? You're going to outspend it, right? And you'll have nothing at the end of the day. So the idea with the endowment is perpetuity. So you always want to marry your spending rate with your rate of returns. And they need to be synchronized and they need to work together. Okay? A couple more things on UP-MIFA. It does have some release provisions in there. They're pretty extreme. So if you do have endowment gifts, maybe it was made to you 20 years ago, you can't find the donor, you don't know where they are, you want to find a way to release them, there's a way that you can do that through the Attorney General. But again, those are really for some very old endowments. And then if you want to look this up on your own time, a great case study about the benefits of UP-MIFA and the ability to spend even when you have an underwater endowment is the North Carolina Symphony. So you can go Google them and look them up. But they were a company that had their corpus drop below, or the fair market value drop below the corpus. They couldn't spend money for a long time. The market took it down. But when UP-MIFA came, they had a very prudent spending policy, prudent investment policy, and they were able to spend again. So you can look that up on your own time. Okay, that's enough about investments. I think what we're going to transition to now is, we have one more polling question. Okay, polling question. Okay, this is an easy one. In a GAAP financial statement, Funds that the board has restricted for a specific program are presented as with restrictions. So again, the board has restricted. Are they with restrictions or without? Shout it out. Yep, without. That's right. Boards cannot restrict any funds. Board can designate funds, but they can't restrict. Only donors can restrict in a gap statement. So next up, please welcome Diane Wittenberg. Diane will be sharing some thoughts on board development. And what I always like to say is behind every great nonprofit is a great board. And so Diane is going to share some thoughts on building a great board.
The secret to a winning nonprofit board. From the earlier polling questions, it seems like, sorry about that, most of us in this room are either board members or we work very closely with the board members, so we're all aware that this core group of individuals has the responsibility and hopefully the ability to shape your nonprofit's future success. Oops, too far. So what are the key responsibilities of a nonprofit board? Did I skip a slide? Yes, okay. So these are some of the questions we're going to go through today. Is each board member addressing their fiduciary responsibilities? What topics should they be discussing? And how do you identify what skill sets you might be missing on your board? Are there key things that you need that you don't have? So what are the key responsibilities of a nonprofit board? How many think it is ensuring the organization meets its legal and fiduciary responsibilities? Hands. Developing strategies, setting policy, monitoring progress. B. Providing financial oversight and engaging in fundraising, and recruiting and assessing board members. Okay, and really we all know it's all of the above, right? Okay, so exit out of here. Yeah, I'm.
You click down there.
Okay, so run well, a board can boost an organization's revenue, provide access to influential people, making great introductions and connections, help manage risks, enhance your leader's performance, craft a compelling mission, but not done well, it can detract from all those things. So the first thing I wanted to talk about was the types of dysfunctional boards and make sure we know how to avoid the types of dysfunctional boards. So the first one I wanted to talk about is a rubber stamp board. We all want board members to be cheerleaders of the organization, and that's fine, but they need to be more than a cheerleader. If they are only a cheerleader and they're simply yes men or women, they're rubber stampers. That's not helping anything. So we don't want a rubber stamp board because that's not contributing anything. A lack of diversity can lead to just kind of a group think and no fresh ideas. So we're going to talk about how to get some diversity on your board. A micromanaging board can disempower your staff, which we definitely don't want. We want to empower our staff, not disempower our staff. Or a balkanized board. A balkanized board is really just focused on their own pet project or their own specific part of the organization, but not the overall mission. We want people who are focused not on one piece, but on the overall mission. So what are the fixes for those types of dysfunctional boards? Well, we're going to look at our board's diversity, and we're going to look at a skills matrix to ensure we have a broad perspective. That's coming up on the next slide. We never want to stifle dissent. We want to encourage alternate viewpoints, encourage minority views. A passionate debate is not something to be scared of. We don't want to be scared of a little bit of healthy confrontation. As long as it's done professionally and respectfully, it's a good thing, not a bad thing for your board. And ensure the focus is always on the mission. So that's how you know it's being done professionally and respectfully. As long as we're all focused on the mission, we're doing well and we're doing what we're supposed to be doing. And then examine performance. You want to do board evaluations. And when we do board evaluations, we're going to talk about how best to do those and how to really see trends and build on the strengths, improve our weaknesses, assign people to be accountable for whatever steps we need to do to improve, and then periodically repeat the process, rinse and repeat, and do it over again so that the board is always learning and always improving. So with that, on the next slide, thank you. A skills matrix is a tool, so we've used this on the board that I'm on. I think I got it from a board that Wayne is on. These are just 9 things. These are certainly not an all-inclusive by any stretch, but these are 9 that I just wanted to bring to your attention, skills that I think every board needs. And then you're going to make a much longer list, which we're going to see in a minute on the next slide. But everybody needs to have board governance. They need to know what their roles and responsibilities are and what your ethical and legal responsibilities are. Every board needs someone who knows financial management and can help with the budgeting and the financial oversight. Be your finance committee chair, be your treasurer. You need someone on your board who knows your programs. So if you are doing mental health, you might want some psychiatrists on your board. You want someone who's familiar with programs who can help critique and further develop your programs and enhance your programs. Human resources is always a good idea to make sure you're in compliance with any laws and regulations there, as well as legal, marketing, and technology. So this is a very short list, and if we look on the next slide, I know this is in your packets, and maybe you can see it a little better in your packets, but what you can do is basically list all the traits down this way, and it cannot just be the skills that we talked about on the previous slide, but also other types of diversity, whether it's gender or ethnicity. You list all the diverse traits you want down the left. You list your current board members across the top. You send this out via a Google Docs link, and it takes less than 5 minutes for each board member to simply put their X's in the columns that applies to them. You get it back from everyone, and it's really easy to see and highlight which lines are empty, completely empty, and where you are lacking in diversity. So it is a really easy but very, very helpful tool to have. So with that, thank you, Wayne. So once we figure out the skills we need, are we done? Have we picked our board member? We find someone with those skills? No, because that's really just the start of it. That's just the talents. You want to make sure that person has the talent, time, and treasure to give to your organization. So the talents are going to be the skills matrix we talked about, plus their ability and willingness to open doors and make introductions for the organization. But that's not enough, because what if this person is so busy they never even show up to any events or meetings? Well, that's not going to help anybody. So we need to make sure they have the time to commit to the organization, not just the skills, not just the connections and introductions, but are they willing to commit the time? Are they going to show up not just for the board meetings, but for the committee meetings, for the events. We need to make sure they are on board 100%. And then lastly, the treasurer, we want to make sure that they are all willing to give to the best of their ability financially to support the organization. So then once we get all the right people on the bus, now we've got the right skills, they've all got the time and talent and treasure to commit to us. Now we need to encourage their participation. So how do we do that? I listed a couple of ideas here. So if you clarify their roles and responsibilities, how they can contribute, like, oh, you're a finance person, so you can sit on our finance committee, or you can be the chair of our audit committee. We don't have anyone who can do that. Once you clarify their roles and responsibilities, then that's going to encourage their participation because they're going to see how they can help. The other thing is regular communication updates. If you as the CEO or executive director of the organization, if you're not communicating to your board what your challenges and successes are, then how are your board members going to help you? If you're kind of out there doing it all on your own and not sharing where you need help, then you're not going to get the help. So communicate to the board regularly what your successes are, what your challenges are, and then that's going to, in turn, give them ideas on how they might be able to help you more. Create opportunities for board members to contribute. When you do your board orientation, when you're onboarding new members, it's a good idea to kind of walk them through what are the different committees in your organization. So show them different ways, and then it might spark interest, and they might say, oh, I plan the fundraising event, if we still have one, Wayne. I planned the fundraising event at my other board, so I can do that for you too. So create opportunities for board members to contribute. Foster a culture of inclusion and collaboration. This gets back to what I said earlier about not stifling dissent. Encourage other points of view. Don't discourage other points of view. And then recognize and celebrate board member contributions. And do that publicly at a board meeting. Thank them. Thank them for, oh, so-and-so made a great introduction, and now we have an opportunity to apply for this grant. Or whatever it was, thank the board members publicly for their contribution. That will not only encourage them to continue to participate, but it will also send the message to the other board members that they get recognized publicly as well. So what should your boards be talking about? I think we've all heard the DEI initiatives over and over. And so this is not only something to think of for your boards, as we talked about a little bit ago on the skills matrix, but also for your organization as well. So think about DEI for both inside your organization as well as on your board. Digital transformation. In the pandemic era, I think we all learned how to either pivot to a virtual or a hybrid world, and a lot of nonprofit organizations learned how to serve their stakeholders and deliver their messages digitally, and so nonprofit organizations are continuing to learn how to optimize that and get the most out of their digital messaging. And that leads into, I'm going to skip to the fourth one, cybersecurity and data privacy. Since we're doing more online, we have to make sure that we're holding people's data securely and we are meeting all the data privacy rules, so that should be top of mind as well. A lot of nonprofits regarding sustainability and environmental responsibility, they're looking for ways to reduce their environmental footprint. And then fundraising and diversification. That's not a new one, but it's a really important one. If you get 80% of your revenue from, let's say, county money, that's a dangerous place to be. What if you lose that county grant? So you want to diversify your revenue base. Make sure it's not concentrated on one thing. The more diverse you are, the more sustainable and stable you are. And then collaboration and partnership. A lot of nonprofits are collaborating and partnering with other nonprofits so that they can pool their resources and maximize their impact. Polling question. What do you think is the most important factor for a successful nonprofit board? Clear roles and expectations, effective communication, trusting relationships, expertise in key areas, strategic vision, or I'm going to add F, all of the above. How come I get all of the above polling questions? Okay, then I think we have another, oh, thanks, Wayne. So then once we are rolling on all these ideas, we want to see how we can continually improve and how we're doing and what we can do better. So the purpose of the goals and the goal of the self-evaluation is to develop your board, ongoing learning, training, development of your board. The evaluation method could be interviews, self-assessments, a self-evaluation. The evaluation questions could be anything from meeting effectiveness to how we're addressing our mission to how we are communicating with each other. And then distributing the evaluations, you want to make sure you do that with the ability for the people to respond anonymously to make sure you get honest feedback. And then when you collect and analyze the data to identify your areas of strength and weakness, don't ignore the outliers, but see where the data is trending. Look for trends and grouping of feedback. And then if you need to schedule follow-up interviews or follow-up evaluations, you can do that if you have to dive deeper into any of those areas that you find. And then when you create an action plan, you're going to strengthen those areas of weakness. You're going to build on your areas of strength. You're going to assign individual board members or members of management for each to-do item, and you're going to just put a regular agenda item on your board agendas. You're just going to add a line item on every month's board agenda to follow up on these action items so that you can hold people accountable. And it's never going to roll off your board agenda, because as soon as you've finished this cycle, it's time to do another cycle. That way your board is continually improving and you're never stagnant. So as I say at the bottom here, the process is an ongoing one and should be repeated periodically. So on the last slide, remember, board members are volunteer workers, they're fundraisers, cheerleaders, they're accountability partners for their nonprofits. Make sure you get the most out of yours. Thank you. We now have a break until 10:35, right, Megan? So as Wayne said, the restrooms are left around the corner, and be back at your seats at 10:35, and we will continue with our next speakers. Thank you.
To go.
All right, everybody, I hope you topped off your coffees, because we are going to begin by talking about lease accounting. which is, yeah, I know. We picked the short straw, so I will let Paul start off now.
Thank you, David. My name is Paul Lewis, and with me here is David Brownstein. We're both audit principals with Haskell and White. Our presentation today is mainly a refresher about lease accounting, and it's mainly focusing on leasee accounting for operating leases. It doesn't cover leaseor accounting. With that, we'll go with the first polling question. So how much progress has your non-for-profit made in the way of implementing the leases?
Be honest, please.
A, not started. B, we are in the research phase, i.e. not started. C, we're implementing, i.e. not started. D, we'll wait until the audit to make all the adjustments. I hope it's not one of those.
We'll try to convince you otherwise during this presentation.
Okay. A little background, this new lease standard, I'm having a hard time saying new because it's about 7 years ago when the FASB announced this new guidance or issued this new guidance. Since then, there were a number of amendments or updates to the guidance, mainly to provide clarifications and practical expedient of how to adopt the guidance. Most recently, actually, they just issued one few weeks ago that talks about lease arrangements between entities under common control. In 2020, there was a delay, or the FASB issued a delay for the effectiveness of the lease standard. So for most of the audience in here and non-for-profits, including as well for-profit entities, private companies, the effective date is for fiscal years beginning after December 31st, 15. I'm sorry, December 15th, 2021. i.e., if you're June 30 year end, the start date of lease accounting was July 1, 2022. Okay. What does that gonna do? So on a very high level, the new lease standard is mainly going to be grossing up your statement of financial position or balance sheet. Here's an example from Amazon. You will see that operating leases has increased their assets by $66 billion. And there is a corresponding liability for $73 million increase in the liabilities. It has a big impact on grossing up the statement of financial position. Now, David will walk us through some concepts of lease accounting.
Well, thank you. So as Paul mentioned, the standard is going to result in a balance sheet gross up. So you're going to have a lease liability. That's the present value of all your future minimum lease payments, and that's going to be offset by a right of use asset. There is an accounting policy election you can make for short-term leases to not apply the guidance in 842 if your lease qualifies as a short-term lease. Before you get too excited, it's fairly narrow in scope. So your lease has to be less than a 12-month lease term, and we're going to talk about how to define your lease term here in a minute. And it has to be 12 months from your commencement date of your lease. And so what is the commencement date? It's the date that you take control of the underlying asset. So I've had some private companies this year, December 31st year ends, that have asked me, hey, at December 31st, when it's showing up on our balance sheet, we've got less than 12 months left on our lease, so we don't have to do this, right? What do you think the answer is? Wrong, exactly. Yeah, it's as of the commencement date, not as of when you apply it. So again, it's fairly narrow, but I have seen a client or two that's been able to apply that accounting policy election. Interestingly enough, your income statement is not going to change. So you're still going to end up with straight line rent, but the way you think about it is your straight line rent is going to be the sum of the interest expense on your lease liability, which we're going to show in a minute how to calculate that. And then the sum of that and your amortization expense on your right of use asset, those two things summed together equals your straight line rent. So it's going to be the same expense. It's primarily balance sheet impact. The transition uses the modified retrospective approach, so you've got a couple of different options. One option is to apply it as of the effective date, and the other one is if you're showing comparative financial statements, you can apply it to the most recent, or to all the comparative periods presented. So what I've seen in most of my clients is they're applying the guidance as of the effective date, which would mean you've got a right of use asset and a lease liability in your current year balance sheet, and then those line items in the prior year would be zeros. I'm not going to go through every single one of the bullet points on here, but there are a few that I want to hit on. The first one, there's a concept known as embedded leases. So your lease it doesn't have to say lease in your agreement in order for it to be qualified as a lease under this standard. The definition of a lease is the right to control a specifically identified asset over a period of time. So a lot of times where embedded leases might show up is in a service contract. And one example I've seen floating around is like a cable box from Cox. You're getting the right to use, yeah, unfortunately there's no materiality scope in the standard, so you're getting the right to use a specific asset most likely with your cable box over a period of time. Your Cox agreement may or may not say it's a lease, but it may actually qualify under the standard as an embedded lease. So you want to think about your service contracts. Things like servers can sometimes fall under that as well. So just be aware of that. There are numerous accounting policy elections. We talked about the short-term leases a second ago. Another one is the discount rate. So when the standard first came out, it required you to use an incremental borrowing rate, which is very subjective to determine and difficult to audit because it's so subjective. There is a practical expedient that's available for private companies and not-for-profits to use a risk-free rate. So for that, you would just go to the treasury.gov website, look at your lease commencement date for the risk-free rate that matches your lease term. If you've got a 7-year lease, you'd use a 7-year lease term. No subjectivity whatsoever. You just pull it straight from the treasury.gov website. So I'm not going to say you have to do that, but it is easier to determine and easier to audit. So take that for what you will, I guess. Understanding the effects on some financial statement ratios and covenants. I was just talking with a banker this morning about, bankers hate this standard because it's messing with all their debt covenants. So if you've got debt covenants on your balance sheet, a couple of the ones that I've seen most commonly impacted, your current ratio, because your right of use asset is entirely a non-current asset, but your lease liability is broken up between current and non-current, so it's going to negatively impact your current ratio. Another one is the tangible net worth ratio or debt to tangible net worth ratio, if you've got either one of those, because a right of use asset is an intangible asset, but your lease liability is very much a tangible liability. So bankers are still trying to figure out what to do with this. And so if you've got some of those in your debt agreements, you might want to start talking to your banker now about, okay, is there something we can do to kind of get this out of our agreement or somehow back out the lease accounting from, because you shouldn't fail a debt covenant just because of a change in accounting. That doesn't really make sense. Some more key concepts. So your leases are assessed as of the commencement date. Again, the commencement date is when you take control of the underlying asset, not to be confused with the lease inception date, which is when all the parties of the lease agree to the terms, or it might be the date that you sign the lease agreement. That is not the date that you're assessing your lease. It's as of the date that you take control of the asset, or the commencement date. Your lease term, I do want to spend a minute here because this is probably where the most subjectivity comes into play. So what we see quite frequently is we've got a 5-year lease and a 3-year option to extend the lease. So is my present value calculation based on a 5-year term? Is it based on an 8-year term? What do we think? The answer, I heard depends out there. The correct answer is it depends. Because what the standard says is you include an extension option to the extent that it is reasonably certain that you are going to exercise it. And so what is reasonably certain? It's higher than probable is basically what we get to work with, but it's a high bar. And so it's not sufficient to just say, well, management's best estimate is we think we're going to exercise it, so we're including the extension option. That's not usually sufficient to include it in your lease term. What is sufficient is, I've seen on a couple of clients, the extension option is at a discount to fair market value. So that would be a pretty good indicator that we would want to exercise it, right? Another client of mine spent millions of dollars in tenant improvements building out their warehouse space, and they're saying, well, we're not going to walk away from all of that early. So that's a good indicator that it's reasonably certain. But there's some subjectivity and some thought that needs to go into, okay, what's our lease term? And again, you might have an early termination clause. Again, that uses a reasonably certain threshold as well. So that's the area that you probably need to do the most thinking about, is what lease term are we going to use? We already talked about the discount rate and the private company election. One other thing to note here is lessees are permitted to defer certain initial direct costs. So if you're paying a lease commission, which would be a little bit unusual as a lessee, but if you are, that you can defer that as part of your right of use asset on the balance sheet. So now we're going to apply some of these concepts Paul's going to walk you through a specific example to help you show how to apply it.
Thanks, David. I think the hard part David has covered, which is a lot of the assumptions. The calculation makes it much more easier after you set up all the assumptions in here. In our example, it's a very simple example. Our organization have a 3-year lease. Over the 3-year period, they're going to pay about $335,000 over the 3-year period. If you thought about it under legacy GAAP, you would look at this 335 divided by your 3-year period. So your lease expense for each year is approximately $112,000. Please remember this number. The agreement meets the definition of a lease under ASC 842. The discount rate is estimated at 7%, either using the incremental borrowing rate or the risk-free rate. It's reasonably certain that we're not going to extend, so we're going to use the 3 years. And based on the calculations, the present value of this $335,000 is going to be $300,000 as of day one of the lease. And day one here is, again, as David mentioned, is the commencement date of the lease. So we need to recognize that activity in our statement of financial position. And that's mainly going to be right of use assets of $300,000. And a lease liability, which is $300,000, and it's broken here between short-term and long-term, but in totality, it's $300,000. So that's day one commencement date. Can you guys see this? Sorry. Okay. So we tried to make the calculation presentable in here. What you will see in this presentation, you'll see the incremental borrowing rate. That's the 7% we used. Column A is our lease payments. So that's year one, we have $100,000, year two, $110,000, year three, $125,000. Total is $335,000. I can't even see it from here. Column B is your interest expense or interest charge. Assume it as a regular amortization schedule for any debt you have. And that's mainly your lease liability multiplied by your incremental borrowing rate over that period. So for year one, that's $18,000. That's the interest charge. Reduction in lease liability. How much are you going to reduce the lease liability? So in day one, we recorded $300,000 as your lease liability. At the end of year one, we need to reduce our liabilities. And that's mainly the delta between how much we're paying on a monthly basis or annual basis as minus the interest expense. That's your reduction in lease liability. So at the end of year one, your lease liability is $218,000. Lease expense, as David mentioned, it's exactly the same as your calculation of a legacy GAAP. So at the end of year one, your lease expense should be $112,000. Right of use assets amortization. I don't like to use the word plug, but it's a plug. And that's mainly to balance the delta between your lease expense and your interest expense. It's mainly the delta between the interest expense and the lease expense is your amortization. So it's not like a straight line as any fixed assets you have and depreciated over a straight line. This is mainly will change over time based on the interest charge. Too much in details? Any questions?
Hey, Paul, isn't it true David has a really good spreadsheet? You just put in the inputs and it gives you all the answers and calculations?
Could be.
That would take all the thinking out of it. No, this part is the easy part, right? It's just a loan schedule basically, but it's the thinking about some of the inputs that's where the difficulty.
So we need to record adjustments as of the end of year one. So the first adjustment is paying the cash. So you credit cash, debit lease liability. Second adjustment, recognize the interest expense or the annual accretion of the lease liability, and that's $18,000. And then the last piece is recognizing the amortization of the right of use asset, which comes to be $93,000. If you net adjustment number 1 and adjustment number 2, this will end up your lease liability for using a T account to be $218,000. That's exactly the number we saw on the Excel schedule. And if you sum 2 and 3, that's your lease expense for $112,000. Year 2 and year 3, it's exactly the same adjustments or journal entries with changes in numbers. I think we just covered this. Back to you.
All right, so polling question number 9. What is the lease commencement date? This is a knowledge check. Is it the date we started making lease payments? Is it the date we took control of the underlying asset? I hear some yeses. The date, yeah, you're right. It's B, the date we took control of the underlying asset. All right, so I think we're running low on time. So just quickly, PwC polled some public companies, but no surprises here what some of the critical items are. Time is of the essence. This is going to be on our PBC list for the year-end audits this year, so there's no reason that we can't start on it now. For most of you, you probably don't need a software vendor. You can probably just do it in an Excel spreadsheet. And as always, having the right team around you is crucial. I won't go through this entire checklist, but I particularly like number 10. If you're stuck, if you're lost, call your favorite CPA firm. Hopefully that's Haskell & White. If not, no more bacon for you. With that, I would like to introduce David Buchanan, who is our virtual Chief Information Security Officer, and he's going to talk about something way more exciting than lease accounting, which is cybersecurity for nonprofits.
Well, hello, everyone, both at Zoom and in person. Thanks for being patient with us there. As mentioned by David, I am David Buchanan. I serve as the virtual Chief Security Officer for Haskell & White, and we're going to talk about a fun topic around cybersecurity today. And I know it's getting close to lunchtime, so bear with me. And let's go ahead and move on to the next slide to start with. As nonprofits, you have some of the same challenges that for-profit organizations face, but one thing that is global to start with is the Internet of Things, the Internet of Everything. The globalized remote workforce has brought a lot of benefits to us as organizations, and also presented a lot of new challenges, especially around information security. A couple statistics just to start you all out with. On average, we have less than 50% of employees of both for-profits and nonprofits alike receive any form of cybersecurity awareness training. And with our global workforce right now, we have more than 90% connect to public Wi-Fi access points with their laptops, mobile devices, and over 60% that use work devices for personal activities. Not entirely unusual, but when you couple that with the lack of security awareness training, it presents some exposure that we'll talk about. Let's go ahead to the next slide. A lot of the time in the news, we see a focus on our opposition, the hackers, right? And it always makes the headlines. It's good for getting clicks. News loves, that the negative focus because it generates attention, and that's how they make money. And the positive side for us as organizations and both decision makers as well as outside security professionals is that we get a lot more information about these attackers now. Their techniques, their approach, obviously profit being a significant driver of why they do what they do. So let's go ahead and meet the neighbors. For the next slide, you've got organized criminal hacking rings. Cybercrime is big business. You've got hacktivists, your political crusaders that have a political bent behind their rationale for what they're going after. You've got regularly in the top 5 source of origins for attacks are the nation states of North Korea, China, Russia, Brazil, Turkey. And then you have our actual attackers themselves. And there's 2 main classifications that we'll just talk about here. You've got your entry-level script kiddies. Script kiddies is kind of a name that has been coined in the industry for hackers that don't usually create their own tools. They don't write their own viruses. It's not that they're plenty smart and they know what they're doing, but they leverage other tools and other code to actually perpetrate the attacks. And then you have the really skilled programmers, the seasoned hackers that are writing their own code. They're writing their own tools, and they are typically the most dangerous because they're typically a lot more focused and pointed in their attack threat vectors, whereas the script kiddies often are like, hey, they take the shotgun approach and throw a lot of malware out there and see what sticks so they can get some money. Let's go on to the next slide. As nonprofits, you really have 3 main categories that we want to look at when it comes to the impact of risk and threats to your organization. You have reputation, you have financial, and you have operational. Financial, of course, if an employee, volunteer, or donor could be tricked into sending money, ACH, wire fraud, setting up fake vendors, or something as easy as, I'm sure someone here in the audience has either received a fake email from a CEO about, hey, I'm in a meeting and I really need gift cards right now. Can you please go buy me 20 gift cards, $50 each, and send me the codes? That's been a common threat over the last probably around 3 or 4 years as an attempt to siphon money out of the organization. Another one on the reputation side is this is really important for nonprofits, as this is your trust, the trust of your donors, the trust of the public in your mission. If you get hacked or if your information's compromised or your website's defaced, that negative publicity really can hamper the trust that donors and public alike put in your organization, and that can hamper your mission. And of course, operational. And to me, this is the most significant when it comes to nonprofits is think about a clinic, for instance. If they got hit with ransomware, they could potentially be shut down and unable to provide critical services to their community. They might not be able to access systems or imaging data. They might not be able to provide the health care that's part of their mission. This is really significant. Let's go ahead to the next. So we talk about, so what? We all know there's risks out there. There's a common response that I know auditors, consultants, and execs alike don't always like to hear this, but a common response is, it's not going to happen to me, right? We're not a target, we're small, or there's bigger fish out there to go after. And that might be true, but as it goes, nonprofits and organizations with larger amounts of one, inbound funding in a diverse array of funding sources, as well as a large quantity of public data, are really key targets for criminals because they can monetize that data a lot easier. For instance, than targeting a large steel factory. So you've got a couple different classifications here. Could be data loss. Are your backups in place? Are you able to recover if you get hit with malware such as just a virus or ransomware? Can you get back and up and running within 24 hours, or is it going to be a week, 2 weeks? Can you get back up and running? This is where you get some of that operational impact and financial impact in there as well. Of course, we alluded on the previous slide, there's the operational disruption opportunity as well. As if you can't access your systems or data, can you really provide your essential services? Are you able to fulfill your mission? There's opportunity cost, lost productivity from your volunteers or your employees. Then, of course, there's the financial loss, which you're all probably mostly thinking of. Well, what are the consulting fees going to be? What's my recovery fees? We've had I knew of a healthcare organization that elected to not pay a ransom years back when they got hit with ransomware in the early days, and ended up just replacing all of they had offsite backups, they replaced all of the computers in question, and there was a lot of money put into that. We're talking a significant amount of funds. And then, of course, insurance deductibles. And a note on insurance, because insurance is part of risk management, and it should be part of all of your approach to managing and mitigating risk associated with cybersecurity. But it's not a rubber stamp, hey, I got a cyber insurance, I don't need to do anything else. And on top of that, cyber insurance often has clauses and requirements that state you must have these type of minimal level controls in place to actually get coverage. So if an event happens and you didn't have those controls in place, this is what they're going to do. Well, you didn't meet our requirements, you're not getting paid. There's no payout. And the other side to that coin is you do get coverage, but as you know with insurance, it works once and then your premiums go up. And hopefully you can continue to get covered. If not, for the same carrier, you might have to move to a different carrier. So those are things to be thinking about. Overall, that cybersecurity aspect, having that plan is crucial as a nonprofit, just as it is for a profit organization. Not just to protect your sensitive information. Earlier, one of our regulatory requirements, for instance, in California, you've got the Consumer Privacy Act, the CCPA. Pretty much most states have a Consumer Privacy Act of some sort for protecting private data, non-public information. If you're doing any business with the EU or with donors that come out of the EU, you're likely going to have some challenges there because you have GDPR, which is a bear to work with. So let's go ahead to the next step here. Focusing on risk management, you've got 6 categories overall here. 5 are defined by NIST, the National Institute of Standards and Technology, which is a common source of standards. And if you have any government contracts or have any government money, often NIST will be referenced. But you start with identifying what are the risks we're likely to face as an organization, as a nonprofit, and have that eyes open discussion, map out what are our likely threats that could impact us as an organization. And then from that step, you move on to protecting. What controls do we have in place to mitigate those threats? Viruses, ransomware. Do we have sufficient anti-malware and endpoint security in place to mitigate that risk? Then how do we have, what type of mechanisms do we have in place to detect when a security or a threat event occurs? Because it's not if, it's when. And a big part from both an insurance and a public trust standpoint is, you've seen breaches countlessly in the news, right? I think the last 10 years, it just keeps getting worse. from a security expert's perspective, I'm more concerned with, did the organization timely detect the issue? How fast were they able to respond and get their system secured back up and running, recovering? And then the piece that's not in the NIST that I think is vital for organizations is the learning step, is lessons learned, because security and the threat environment is constantly changing, right? So your plan, your information security policy, your program needs to be a living, dynamic, beast. It needs to be growing with you as your business and your nonprofit changes. One of the key pieces out of this, I want you to just mentally take a note of, is, do we have an incident response plan? And if we don't, you should reach out and start a conversation with your Haskell and White contact about what it takes to get one of those put in place, because that's an early step that you'll want to make sure you have. Let's go ahead to the next step. We're going to focus a little bit timing wise on our environment, and please feel free if you do have any questions as we're working through the presentation, this session, let Megan or throw it in the global chat and I'll do my best to respond to them as we're talking. So we're going to focus on our environment. I'm a big proponent of, it is almost impossible to protect effectively what you can't see. And a lot of organizations today have this massive visibility challenge. And it's only compounded by the growing pressures placed on us by, it could be board pressure, albeit that should be there, donor pressure, market pressure, financial environment pressure, all of that. How does that impact, we have a mission, we're growing fast, we're cash flush right now. What are we doing? We need to focus on the mission. And often everything else kind of goes to the back, including sometimes security. And that, unfortunately, that's normal, but it's a good reminder to take a breath and say, okay, it's excellent that we're moving so fast. It's excellent that we're growing. But are we also, as we grow, putting in appropriate countermeasures and appropriate controls in place to protect us and protect our mission as we grow with that? Because your threats, your exposure levels change as you grow. And on to the next step. I wanted to really focus here on ransomware because it is one of the main cybersecurity specific threats that impact nonprofits, because one, it's so prevalent. Ransomware is a specific type of malicious software, right? That denies you access to your own data. It encrypts your data, blocks access to your system, and says, you'll see a note, pay me X amount of Bitcoins at this address, or you lose your data, period. The way that it usually gets into your system, commonly through email, visiting an infected website, it's called drive-by downloads. And another key piece is, if any of you use Microsoft Remote Desktop for remote access to your systems, but you don't use a VPN first before connecting to remote desktop, that is a common vulnerability that is used to propagate ransomware, is the remote desktop protocol on unpatched versions of Microsoft Windows. And a key piece here just to remember is ransomware is rarely discovered alone. It always brings friends with it, usually a remote access tool or a way to reinfect a system, and the off chance that security control does block aspects of the malware. So it goes back to defense in depth. Let's go back to the next slide here. We've got a list, a big list. There are over 241 ransomware variants here. This is not all inclusive. This is just the ones I decided were, worth mentioning. Biggest exposure on the market. WannaCry, you'll see that on the left there. WannaCry was a huge threat. Early days impacted a lot of organizations, healthcare included, hospitals included. Hospitals lost access to imaging systems, lost access to their servers. And a big part of this was due not because they didn't have any security controls, but just because they didn't patch, they didn't run specific Windows updates on their systems. And that's part of that system hygiene, where often you get ultra focused on Well, we've got all these these mission related goals that we need to address. And, we're short staffed, we're short resource, we're moving so quick. Often focus doesn't include, well, we should probably schedule some maintenance downtime on a regular basis to make sure our systems are patched. A lot of the hospitals that got hit across the UK when ransomware first really hit the headlines could have been protected if they had just kept up to date on Windows patches that were released within the last 7 months. Let's go on to the next slide. A couple real world examples of what these ransomware pop-up messages look like. Your computer's been locked, they give you a fake, DOJ emblem. A lot of these messaging are intended to create the FUD, right? The fear, uncertainty, and doubt, and to make you act quickly. You'll see it's regularly expected that the amount of Bitcoin or dollar value of ransoms typically ranges from as low as $1,000 to $1,500 up to $5K. Let's go on to the next slide. One of the largest ransomware demands that actually has been paid out was around $1 million. That's a ton, right? But then you also look at, well, this was a while back, this was in 2019, but Aaron County Medical Center, they estimate to spend around $10 million in responding to an attack that involved a $30,000 demand. And that goes back to us to just say, you've got about the mentality of, oh, we don't pay ransoms. I won't buckle down to terrorists. That doesn't really work with ransomware. And really, if you got a good cyber insurance policy, let's go on to the next slide. They're going to be the ones that are going to negotiate and work with you on this. They'll actually negotiate with the ransomware demands and work on paying that out. They track all the Bitcoin wallet IDs. They track where the payments go. It is in the hacker's best interest to actually release your data if you pay. So then they have a reputation of giving you your data back, and then they'll get more money. Which of the following is the name of a ransomware? Enjoy. Let's go on to the next slide. All right, humans, we're hackable. Humans are the greatest asset in the organization, right? They're also our biggest vulnerability. And in closed door conversations, the joke with IT is, well, the best, easiest way is to, unplug the internet and get rid of the humans. You can't do that. It's not a viable solution. So we go to the next slide. The answer is training. Early, often, and regular. Keep it moving, like on a stated frequency. The more training people have, the more competent they are, the more confident you are of being on the lookout for, hey, this doesn't look right. I'm on this website. It doesn't look normal, or I'm getting these emails and the sender looks right, but there's a lot of misspellings and I'm not sure, this doesn't feel right. When in doubt, report it. Get it confirmed. Training is positive, and training is one of the lowest cost methods you can do to improve your cybersecurity. Let's go on to the next slide. So we've got some preventative measures that we want to really focus on here. And we go from passwords and multi-factor authentication. Passwords, I'm not a fan of. You need to have strong passwords if that's all you have. But really, the thing that's going to give you the best protection is if you have a properly implemented multi-factor authentication solution that protects the account. So if someone gets that password, it's not valuable because it requires you to have, whether it's your phone as that second factor, or a specific app that gives you, hey, is this you logging in that you have to approve? That's far more secure than relying on a password. And as a side note, where possible, I know a lot of folks will use a text message verification as a form of multi-factor. And yes, that is multi-factor authentication, but it is the least strong of the types of multi-factor authentication because it relies on the text messaging network, which is an old technology. It's old. They didn't build security into that. So where possible, use the app on your phone. Patch management, hygiene. run those software updates, get with your IT teams, make sure that we're running updates, doing maintenance on a regular basis. Data backups, make sure those data backups are done off-site, not just with a plugged-in hard drive. If you get hit with ransomware and there's a hard drive, external hard drive plugged into your computer, and that's your backup, that ransomware is going to hit that hard drive too. Make sure you've got good antivirus. Check with your IT. What are we using? Is it the cheapest solution? A free solution? Might not be the best. And of course, secure your online donation process if you offer that. The payment card industry DSS is important. Make sure if you do accept credit card donations online that that is compliant and secure. I saw your question, Claudia. Thank you. I hope that did answer it. Let's go ahead to the next. Big 3 takeaways: email security, security awareness training, and an incident response plan. I want you to think about, go back to your organizations and ask, what are we doing around email security? Making sure that we're doing what we can to prevent phishing. For security awareness training, good question, Karen. There's lots of options out there. Look at KnowBe4, KNOWBE number 4, KnowBe4. There's PhishMe, PHISH, PhishMe. There's human security. There's a lot of options out there, and a lot of them are very low cost, very affordable. And of course, the incident response plan. These are the 3 things I want you to make sure that you have in place. Let's go on to the next one. Here we have that clause. Often in insurance, do whatever you can to avoid a breach. You'll see a clause in there. 25% of small businesses, including nonprofits, have some sort of cyber insurance policy. Most do not actually meet the requirements to be covered. So what do we do about this? We've talked about some preventative measures. We've talked about some of the risks out there to nonprofits. If we go to the next slide, this is not the response, right? And I miss out because I'm not in sight with y'all and I can't hear if there was any chuckles or if people are falling asleep. But I hope this generates a little bit of ha-has. Mischief not managed, sticking to your head in the sand, it just doesn't do it. Often we'll hear, oh, we accept the risk, we accept the business risk. And it is absolutely fine as business decision makers to accept business risk, but you want to make sure from a due diligence standpoint that you've documented your understanding of the risk. And I am over time right now, so I'm going to end with cyber risk is organizational risk. Remember, cyber risk is organizational risk. And I'll hand it back to Rick. And if you have any questions, please reach out to Haskell and White. Thank you all.
Terrific. What a morning, from fundraising to investing to board development, lease accounting, ending with cyber. That was great. Thank you very much for attending with us this morning. I know everybody's super busy, so we really appreciate the time and appreciate you being here. A couple of administrative items as we end our conference today. So one is parking validations are available for you in the back. So Leah and Megan will have those in the back for parking validation. Also, if you would like CPE for today's session, those certificates will also be in the back, and Leah will have that available for you too. At the very last page of the slide deck you have, there's a QR code on there. And of course, we're always interested in making this seminar and this workshop as meaningful as possible for everybody. So please scan the QR code. Give us some feedback. If there's topics you want to hear us address in the future, please let us know that. But again, we are believers in continuous improvement. So anything we can do to make this better, please let us know. And I think that's it. So thank you everyone for attending. Some of the Haskell and White folks will be hanging out afterwards. So if you want to hang out and have another coffee or chat about anything you heard today, we're happy to do that. Thank you and have a wonderful day.